Greetings, viewers. Please permit me to introduce myself. I am Dr. Isha Raval, working in the capacity of Associate Professor and IQAC Coordinator at Vivekananda Institute of Professional Studies, Technical Campus, Delhi. Today we are going to deliberate as a part of the series on security analysis and investment management, a very important topic, which is what is investment, why should one invest, and also what are the various stages when we try to invest and we decide that yes, we are going to invest, but then what are the different stages in it. So to begin with, let us understand what exactly is investment. Investment is actually foregoing your current consumption. It is not to consume right now so that you can build an empire, so that you can increase your future consumption, so that you leave something for your future generation. Say, for example, you just have your idle cash lying in your house. Either you put it in a drawer, in a locker, and the piles of cash just stay there. Or maybe you invest that, or you don't invest, rather you spend that money on buying basic necessity goods. In fact, if you do not do that, if you avoid storing money, if you avoid preserving your idle cash, rather than that you prefer investing it in such instruments, in such financial assets which are likely to generate enough returns. That is how you can build real amount of wealth. Interestingly, if we have a lot of idle cash with us, we have piles of cash lying in our drawer, which we witnessed during the time of demonetization. When the government announced demonetization, we could see sacks of cash, being thrown. At times, people were worried that what do we do, because this is idle cash and we really cannot use it right now. So what is the purpose of investment? Instead of keeping that cash in your houses, instead of keeping that amount of cash in your savings bank account, which is not even generating enough return to cover the inflation, it is better we opt for such instruments. It is better we opt for such financial assets which can generate a return which is much, much higher than the basic rate of inflation in the economy. Let me cite an example. Say, for example, you have 100 rupee today, and if I give you an option that you take this 100 rupee after 1 year from me. Obviously, a lot of people will say, in fact, majority of you will say, we would want to take this 100 today rather than taking it 1 year down the line. The reason? You know that the purchasing power of this 100 is going to get depleted. It will diminish over the period of time, and after 1 year, the same purchasing power will not be with this 100 rupee. You will be able to buy lesser amount of goods with this same amount of money. That is why the purpose of investment is that we invest, we put our funds in such assets, we put our funds in such instruments which generate good amount of return, at least to cover the basic inflation rate. Because if we do not invest, we actually are likely to incur loss in terms of wealth creation. So overall, we say that consumption should be curbed today so that we can consume more at a later stage of life. Let us see, we understood what is investment, but what exactly is investment management? It includes handling, it includes management, it even includes how to take care of the financial assets which you have purchased over the period of time. These financial assets can be shares, they can be bonds, these can be government securities, this can even be gold, this can be real estate, precious stones. A lot of people prefer investing in gold. It is one of the most favorite asset. And we invest in gold considering that if we put our money today in gold, this is likely to get double or triple. But then, well, what do we know that after 5 years, what will be the value of gold? How do we predict it? How do we decide that what is the right time to buy and sell all these financial assets which I have discussed just now? So investment management is much, much beyond just buying and selling of financial assets. It is actually about how do you plan, how do you decide when to buy, what should be your holding period, and when to dispose of. In totality, if we look at investment management, it actually estimates the holding period, whether you want to hold it for short run, you want to hold it for long run, and that too in line with your investment objective. that what is your purpose of putting your money into a particular investment. So the other names, if we look at about investment management, it is also known as money management. At times it is known as a portfolio management. Portfolio, the word itself says that when we create a portfolio of financial assets, that means we are not interested in putting all our eggs in just one basket. Rather, we want to diversify. So we do not want to stay invested in one financial instrument. Instead, we prefer investing maybe some amount of money in shares, or within the stock market, we want to invest in different types of shares belonging to different sectors so that we can protect ourselves, we can minimize our risk. So portfolio management is another name given to investment management, and certainly wealth management. As I just quoted, that investment is the main purpose of investment is to create wealth. So investment management is also known as wealth management. Now, when we talk of investment management, there are different processes. The process is different from the perspective of a corporate, and the process is different from the perspective of an individual, a retail investor. The corporates decide whether to put their funds in huge machinery. They may have an objective to start up a new factory. They may be looking for geographical diversification. They may be aiming to start up a new venture. So the perspective of investment is completely different for an organization, for a company, for a corporate, whereas the perspective of an individual is completely different. Corporates, they actually use capital budgeting techniques to decide what sort of investment they have to make, whereas the individuals follow a very simple approach wherein they look at their objectives and then they look at their constraints and then they decide where to put their money in. So today's entire series, we are going to focus on how an individual actually analyzes the scenario and decides that this is the entire process he or she undergoes before finalizing or creating his or her portfolio. As you can see on the screen, the very first step as a part of investment decision making process from the perspective of an individual is specification of investment objectives and constraints. The objectives, I may have an objective wherein I want to create my wealth, maybe for the wedding of my child. I, as an individual, may be wanting to prepare or accumulate funds for the higher education of my child. If there is a person who's unmarried, he may be collecting money to get himself settled first, buy a property, buy a home. There can be multiple objectives of an individual. If somebody who's in the middle age may be wanting to create funds or in fact, create wealth so that he can actually enjoy when he retires. So he may be indulging in retirement planning. That could be one of the objective of investing his or her funds. The other objective could be to ensure future, to have a regular pension income. There can be. So every individual's objectives are very clear from the other. We may be guided by our objectives when we actually decide what alternative are we looking at. For example, if I may be interested in accumulating funds for the education of my child, I will prefer investing the funds for a longer duration of time if I know that I would be requiring them maybe 8 years or 9 years down the line. That is why the objectives of every individual are different, and they keep these objectives in mind before they land up with any alternative. Now, these objectives are in contrast, guided by certain constraints. What could be the probable constraint? The first constraint can be the time, the availability of time with you. That means if you have enough time, you want to be there, staying invested in the long run, then in that case, you're going to choose those alternatives like real estate, like property, or maybe even gold for that matter. But if your time duration is very, very less, you know that your spare funds which you want to invest are available to you only for say 3 months or 4 months or 5 months. In that case, because the duration is lesser than 1 year, you may opt for creating a FD with a bank account wherein the duration is for a limited period of time. You may opt for money market instruments You may invest in a treasury bill, you may invest in government securities. So the constraint with which you are guided has to be in line with your the investment alternative you choose. The another constraint can be the risk taking ability of an individual. For example, if I am a risk averse investor, if I wish to avoid risk, then I may not be very comfortable investing in the stock market. So what is my risk taking ability? What is my appetite for taking risk actually determines the kind of investments I choose in the short as well as the long run. So a person who's really risk averse may opt for mutual funds than opting for stock market. A person who's extremely conservative, who's not very comfortable with these ups and downs of the market because of lot of volatility in the market, he or she in fact may opt for an instrument like a bank FD, or she may invest in an instrument like your post office schemes, which are considered to be one of the safest investment alternative. So every individual who's actually undergoing an investment process is deciding the investment is guided by two things. The first, what is the ultimate objective, and what are the constraints, the limitations of that individual. As you can see, the second step is choice of the asset mix. What sort of asset, the combination of assets you as an individual wish or aspire to hold. Because once you have identified the objectives clearly, you know your constraints well, then comes the time where you start exploring the various alternatives. There are multiple options available to an individual, and these assets may range from bank and post office deposits. One of the safest investment which people think they are, but when they are taking lesser amount of risk, because bank FDs are considered to be safe, and especially if they are opened in a public sector undertaking bank, or the post office deposit schemes, because they are backed by the government, they are considered to be one of the safest investment alternative. We all understand that if the risk is less, so will be the return. Similar is the case if somebody has a low risk appetite and is opting for bank or post office deposit schemes, the return which he or she is anticipating would also be on the lower side. The second alternative available to an investor is, say, equity shares. So an aggressive investor who's a risk lover and who wants to explore and understands the nuances of the ups and downs of the stock market will be comfortable investing in equity shares. He may opt for the equity shares which are mid cap, maybe small cap, or even blue chip companies, or an investor can actually invest in the index as well. The famous indices in India, as we have the Nifty and Sensex. So he or she may try or prefer investing in the equity market through this route wherein they put their funds in the index. The third alternative available to an investor are the bonds, the debt market. So somebody who's comfortable with the wholesale debt market and wants to lend instead of becoming the owner by purchasing an equity share, somebody who wants to come into the category of lender may opt for investing in bonds or debentures. The fourth alternative, people who are again risk averse, very conservative in nature, they will prefer investing in government securities because they know their money is not going to go anywhere, irrespective of the fact that the return on these government securities is very, very limited, and at times it fails to even cover the inflation rate in the economy. Now, a naive investor, an investor who's not much knowledgeable about the stock market, who does not understand how the markets are driven, who does not understand the kind of analysis which goes into selection of securities, may prefer to seek the expertise of somebody who has been into the market, and they look for a route called mutual funds. So they invest in mutual funds because they know that the mutual funds are being managed, are headed by a manager who's aware of the nuances of the market, and they know they are going to park their funds in safe hands. So people who prefer to invest in the stock market but do not wish to enter directly into the market because they do not possess that knowledge will prefer investing in mutual funds. Again, there are different types of mutual funds, so depending upon the objective and the duration and the risk appetite of the individual, he or she may opt for different schemes of mutual funds. The next alternative available is the real estate sector, wherein the money stays invested for a longer duration of time. So people who are looking for appreciation of land, appreciation of property, and are for the long run, want to stay invested in the long run, will prefer investing in property. One of the safest option again available to the individuals, to the investors, is gold. As I just said, that gold is one, I would say, metal which is preferred by almost everyone. If you have a piece of gold and you travel across the globe, you can sell that piece anywhere. But if you have the 2000 rupee note, it may not be accepted anywhere beyond India. So even gold is preferred much. It is far better, I would say it is a better instrument than all the other assets, because this is one thing which is saleable across the globe. And that is why a lot of people prefer investing in gold, and they say that it is one of the mandatory financial asset which they must hold as a part of their portfolio. There are many other metals apart from gold which are available and people invest in them. Then financial derivatives, people who are converse, who understand and are very comfortable and have our high risk taking ability. They prefer investing in financial derivatives. They may take up a futures contract, they may buy a call option or a put option depending upon their understanding of the market and their risk appetite. Life insurance is another alternative available, wherein every individual feels that insurance is one sort of security which they purchase, that what if they are not there, what happens to their family. So they try to accumulate by paying premiums a complete sum of amount which may be at least given to their family when they are no more there. So that is one alternative which people prefer. But if we look at from the perspective of investment, insurance is actually not investment. And at times we misunderstand it, considering that insurance is a kind of investment which we are doing, but it is technically not an insurance, it is not an investment, rather it is just, getting the security. It is just to procure the security. Then the another and one more instrument which I would like to talk about is the money market instruments. So all the investors with a very limited duration of time, say which is less than 1 year, will prefer putting their money in money market instruments, because these are those financial assets which can be traded for a period lesser than 1 year. It can be called money, it can be the treasury bills, it can be such securities which are commercial papers, certificate of deposits, wherein you can trade, you can stay invested for a period lesser than 1 year. So as we've understood that after identification, the first step of the constraints and your ability of the risk and your objectives, and after elaborating, after studying the various choice of the asset mix available, the next step, the third step which an investor faces is formulation of portfolio strategy. We have two types of portfolio strategies. One is the active portfolio strategy and the second is your passive portfolio strategy. If we talk about the active portfolio strategy, somebody who is actually monitoring the ups and downs which are happening to the financial instruments which he or she has purchased, who is regularly checking the rise and the fall in the market value of the securities, in the market value of the entire portfolio which he is or she is holding, is an active investor. An investor who keeps a track of the increase as well as the fall. That person is categorized as an active investor and somebody who follows an active portfolio strategy. But if you look at the general public, majority of them, once they buy an instrument, they actually forget it. You create an FD and you put it in the locker. You buy a ULIP, a unit linked insurance plan. You put it in the locker, you put it in the almirahs, and we do not know what's happening to the ULIP plan. Though it gives you an alternative, you can switch, but majority of the people, they think if they've done an investment for say 5 years, they actually pick up that document, or if it is in demat form, they just buy and they forget it and they check it once the maturity period is approaching. So such type of people who are not so active are categorized as passive investors, or investors who do not follow the return on their security or the return on their portfolio. So if they've invested in multiple things, so it is portfolio. If they've invested in just one instrument, then it is just one instrument. The fourth step is analytical selection of securities. And there are two types of analysis which an investor does. The first is fundamental analysis, wherein you understand what ought to be the price, what is the intrinsic value of a particular share or a particular security. And then you decide whether to buy or not to buy that particular security. The second alternative is the technical analysis. That is, when you are studying how are the prices moving, when you are studying that if a particular stock is rising continuously, so you say that yes, because it is in the momentum, it is rising continuously, it is likely to rise further, and you decide that I'm going to buy that type of a stock. So this type of analysis is categorized as technical analysis. Step number 5 is portfolio execution. Now this is the time when you actually decide that I am going to execute buy the securities. So investment objectives and the constraints, they are specified, the asset mix is decided, the portfolio strategy has been developed, and the specific securities to be included in the portfolio, they have been identified. So the next step is to implement the portfolio plan by buying or selling the specified securities in the given amount as decided by you. This is the phase of portfolio execution. Step number 6, which is the second last step, which is portfolio evaluation. So once you have bought the securities, portfolio performance evaluation essentially comprises of two functions: the performance measurement and then performance evaluation. Performance measurement is an accounting function which measures the return earned on a portfolio during the holding period or investment period, whereas performance evaluation it addresses such issues as whether the performance was superior or was it inferior, whether the performance was due to skill or was it due to luck. So this is one step where you see where do you stand after you took the decision to buy, how are you performing. Here you evaluate your performance and then decide whether you are up to the mark or not. The last step as a part of investment decision making process is portfolio revision. Under this, it involves changing the existing mix of securities. This may be affected either by changing the securities currently included in the portfolio or by altering the proportion of funds invested in the securities. New securities, they may be added to the portfolio, or some of the existing securities may be removed from the portfolio. Therefore, we can say that portfolio revision leads to either purchase or sale of securities. The objective of this step, the portfolio revision, it is exactly the same as the objective of portfolio selection, like maximizing your return for a given level of risk and minimizing. It could be maximizing the return or minimizing the risk for a given level of return. So the ultimate aim of portfolio revision is the maximization of returns and minimization of risk. So the primary factor which is necessitating portfolio revision there are two factors. One, the changes in the financial markets since the creation of the portfolio. And the second could be because you've changed your risk tolerance. Now you know that you have either more funds or you have more investment opportunities. That is why you decide that you're going to revise your portfolio. So this is all about all the 7 steps in the investment decision making process. Wishing you happy learning. Thank you so much.